Thanks for listening in for our Q4 investment update. I'm Tony Welch, Chief Investment Officer at Signature FD. So we're going to keep this relatively brief today because a few weeks back we did a special edition that focused on election trends. And I think that remains relevant, and that's where we're getting a lot of client questions today. So we're happy to get that to you if you haven't seen it yet. But for today's agenda, what we're going to focus on is what drove a strong third quarter for most asset classes and how we see the data shaping up on a forward-looking basis. We're going to take a look at the economic cycle and why it's been surprising to the upside. And finally, we'll touch base on our portfolio positioning and what could potentially cause us to shift course in our investment strategy. So the third quarter was a strong quarter for most asset classes. And here we're showing select asset class returns for the year through September 30th. Large cap US stocks have led the way up, but the other asset classes have done well additionally. Large caps are up about 22% year to date, and international stocks and small cap shares have also participated in that advance. Small caps have returned over 11%. Developed international stocks 13.5%, and emerging markets have returned over 17%. Commodities and bonds are up mid-single digits, and the dollar is almost unchanged. So those are important assets for stock returns, and they've been solid, but most importantly, those other asset classes have been stable. That stability has helped drive an economic environment that we might describe as not too hot or not too cold. And the investment asset classes have all outperformed short-term T-bills on the year. Cash is set to get less attractive if the Fed continues with their rate cutting cycle. So speaking of the rate cut, the Fed cut 50 basis points at their September meeting. Prior to that, monetary policy was quite tight, and it still is somewhat tight when compared to inflation. Now, normally, restrictive monetary policy would be a headwind to the stock market, but this year the market has somewhat bucked that trend. And that might be because longer term interest rates have been pricing in the start of an easing cycle for most of this year. So on this chart, I'm showing the Fed funds rate in purple, 2-year Treasury rates in orange, and 10-year Treasury rates in blue. Treasury rates are lower than where they began the year, and really since that spring peak have fallen quite a bit. Now, easing borrowing costs have supported stocks this year, but not just the mega cap stocks. Here in this chart in blue, we're showing a market index that better represents the average stock. In orange, we're showing the 6-month change in corporate bond yields. When yields are falling, the average stock tends to benefit. Now, we especially saw that effect in the third quarter. Many of the market's lagging stocks were positive and even outperformed the mega cap growth stocks. So the implication is that market participation improved in the third quarter. Here in this chart in blue, we're showing the S&P 500 in the top clip, and in orange in the bottom clip, we're showing the percentage of individual stocks across small, mid, and large caps that are trending higher. For much of the third quarter, this metric was comfortably above 50%, which means that most stocks are in an uptrend. Typically, bear markets tend to form over time. You might expect to see most stocks trending lower before the benchmarks follow suit. So strong participation like this is a good sign of a healthy bull market. Now, interest rates have moved lower, largely owing to the beginning of the Fed easing cycle, but it's the improvement in inflation that is allowing the Fed to ease. So here in this chart, we're comparing stocks in blue in the top clip to inflation in orange in the bottom clip. Historically, when the rate of inflation is easing, stocks have performed better than average. This one indicator gave us a positive signal way back in August of 2022 that inflation was moving in the right direction to support the stock and bond markets, and this remains positive today. For most of this year, Signature FD portfolios, they've had an overweight allocation to stocks with an underweight allocation to bonds. We've been trying to stay on the right side of those improving inflation trends, but also economic growth has been quite resilient for the past 2 years. So this chart shows the performance of stocks versus bonds in the top clip in blue. When that line is trending higher, it means that stocks are outperforming bonds. And when it's trending lower, it means that bonds are beating stocks. We can see that stocks have been clear winners the past few years. Now, the bottom clip shows economic growth relative to steady state potential growth in orange. And the black dashed line is inflation relative to its average of the past 5 years. So what those two lines tell us is that economic growth has been strong and inflation trends have greatly improved. And historically, that has been a great combination in which to favor stocks over bonds. Now, we're going to come back to this concept a little bit later when we talk about what we're watching ahead. There may be an argument to be made here that this bull market is getting somewhat long dated. Recently, it reached its second birthday, and in those 2 years, it's added about 60%. But old age doesn't necessarily mean the end for a bull market. This table here is showing all modern bull markets that reach the age of 2. And in the second column here, it states whether it reached the age of 3 without a bull market or without a bear market. Now, in 7 of 12, the bull survived until its third birthday. In 3 of the years that it didn't, it was directly related to a recession. And in the other 2, there was a recession scare. So in other words, if the economy remains solid, we should probably expect to be celebrating a third birthday this time next year. One trend that's been pretty consistent, even in those bull markets that reach the age of 3, the advance tended to slow down in that third year. So that's in line with our expectations here for the next 12 months. So the economy remains in good shape, but how has it continued to beat consensus economists' expectations? Well, we think we're in something of a positive feedback loop. Real incomes have been rising since late 2022. Rising real incomes support strong consumer spending. Strong consumer spending supports strong earnings and profit margins. And with solid fundamentals, companies have created jobs and kept layoffs to a minimum. A solid labor market then goes on to support rising real incomes. This is the current circuit as we see it. So let's dig into this a little bit. Here in this chart, the orange dashed line is showing the change in real inflation-adjusted income. It's currently growing at about a 3.2% rate. The blue line is the change in real inflation-adjusted consumer spending. Now, one thing we know about the U.S. consumer, if they have a job and income is on the rise, they tend to spend. There's a tight correlation between inflation-adjusted income and inflation-adjusted spending. Currently, real income is up about 2.9% year over year. I'm sorry, real spending is up about 2.9% year over year. This is very important because private consumption is 68% of U.S. economic activity. Now, with economic growth supported by consumer spending, we're seeing support for corporate earnings. The bottom clip of this chart shows the annual change in economic growth in red and the change in corporate earnings in black. Now, there's a tight correlation between economic growth and earnings. Through Q2, nominal activity grew 5.7% and earnings grew about 10%. So how are earnings growing faster than the economy? Well, profit margins are expanding. Another feature of solid economic growth is that corporations are maintaining pricing power. Here in blue, we're showing corporate earnings. Now, the bottom clip in red, that compares inflation to unit labor costs. Inflation has eased, but unit labor costs have slowed much more. In effect, corporate pricing power has outstripped the cost of production, especially on the labor side. That's historically been quite bullish for corporate earnings. Now, you might ask, aren't wages still rising pretty fast? And the answer would be yes. Wages are growing about 4% annualized right now. But positive productivity trends have been a big offset to wage inflation, and that's been helping to keep those unit labor costs down. As we alluded to earlier, strong earnings and rising profit margins, those are supporting job creation. This chart shows the monthly change in payrolls this year. After a weak June, payroll growth has been accelerating. Positive job creation is historically a good marker of a healthy economy. So all of that sounds pretty bullish. And in fact, we've been lined up with these trends here in 2024. But what we're watching to become more cautious and potentially neutralize that stock market overweight, investing is certainly more complex than this, but this table is a good historic look at returns for stocks and bonds in different growth and inflation mixes. We can categorize growth as rising, stable, or weak. We can do something similar with inflation. It's either rising, neutral, or falling. So let's start with the stock column. You should note that the annual return for stocks is pretty positive in every one of those growth modes, whether it's rising or stable. It's only when growth is weak that stocks have had negative annual returns. The worst returns have come in those outright recessionary periods when growth is weak and inflation is falling. Now let's compare those numbers to bonds. Bonds have historically been more stable, showing positive returns across regimes, but the best returns for bonds have come when inflation is falling or stable. And that implies that inflation is more important than growth for bond investors. And this all makes empirical sense that equity owners would care more about growth and that bond investors with fixed payments would care more about inflation. Now let's think about when bonds are more competitive or have even outperformed stocks. Well, that's been in those weak growth regimes. Bonds have very clearly been the better place to be. So if we see recession risk elevating, we would likely move more capital from stocks and into bonds. Now, the other scenario I would think about is a spike in inflation, which would hurt bonds near term, but longer term higher starting rates could support bonds over stocks. For now, we're in this green highlighted regime of growth rising and inflation neutral, and that is supportive of a stock market overweight. So let us know if you have any questions that we can answer for you on today's topics or anything else. And as always, I want to thank you for joining us and have a great quarter ahead.